Passive Pockets is presented by Equity Trust.
Today's episode covers two critical topics for passive investors. First, a rare look behind the curtain at what happens when LPs vote out a manager and a new operator takes over a fund. Then we dive into the fundamentals of triple net lease investing and how investors can use this asset class to create stable returns without taking on operational headaches.
Welcome to Passive Pockets, the passive real estate investing show, brought to you by Equity Trust. I'm your host, Jim Pfeiffer, along with my co-host, Paul Shannon, and today we're joined by Zane Schartz from Freedom CRE, a commercial real estate fund manager with a front row seat to one of the more unusual LP-led transitions we've seen. Let's get into it. Zane, thanks for being on the show.
Thanks for having me.
First, just give us a little bit of your background, where you are and what you do.
Based out of Dallas, I'm the president of Freedom Commercial Real Estate. I've been working in private equity real estate investing for about 8 years now. Started my business journey 6 years at Group prior and had a really good learning experience there. Had a lot of growth and learned how to do things good and bad, and took those learning times and started my own thing about 2 years ago. And the name Freedom Commercial Real Estate has two meanings behind it. The first one is really want to help investors on their journey towards financial freedom. And the second one is freedom, in my opinion, true freedom comes through Jesus Christ only. So, we like to help from an investment standpoint and also from a personal standpoint.
Excellent. So for this, I think we talked about this a little bit. It's going to be kind of a two parts because there's two super interesting things that happened. And the first is, you worked for, as you mentioned, basically a multifamily operator who got into a bunch of different things, but you managed the commercial real estate triple net lease part of that company. And that's where, we first interacted because I am an investor in that with you. And he was voted out as manager, and you took over as manager of this fund. Without getting too deep into the details, what happened there?
In my time at that company, I ran these funds called CRE funds, and they were basically various funds that we bought single-tenant net lease properties, and I had a lot of freedom to run them at that company. I had a team under me, and it was really fun. When I left that company about 2 years ago, I got a call about a year after I left from one of the largest investors in the funds, and they reached out to me and said, hey, things aren't going well at this company. We want to save our good investment. So they reached out to me and said, would you be interested in taking back over these funds and managing them for the investors and basically protecting their investment? I had a lot of investors reach out about that. And I said, yeah, of course. I love these funds. I love building them and I know them better than anybody. So it was interesting and never thought it would happen, but getting that call was a huge honor. So what happened after that was, according to the governing documents for these funds, the investors can take a vote. And if they get over 75% of the investors to vote affirmatively, they can remove the managing entity. And that managing entity was effectively removed after the vote was passed. And we have since been managing the funds. We're still under some legal battles. That's just been a very interesting process, but we have control. And hopefully from an investor standpoint, it's been a little more clear now. And I'm sure there was some uncertainty and lack of clarity on the front end, but I tried to handle it with humility and grace and never talk poorly about anybody. And I hope that showed. And I hope that it shows moving forward as well.
That's a really interesting experience, I think, probably for you as the GP, but also for the LPs involved. I have not been a part of an experience like that before. You talked a little bit about the process of voting out a manager. I'm curious, from sort of the grassroots level, how do LPs find out who the other LPs are and begin the process? Are there a couple of key LPs that then rally the troops, so to speak, or do they rely on you to communicate? Because it seems like there might be a conflict of interest there potentially. How did that all unfold?
This was an interesting situation. I'll answer kind of the more common route is, in this situation, one of the largest LP investors reached out to me and they knew that I had managed them in the past. So they kind of rallied the troops. They sent an email to all of the LP investors. And I guess your question was, how did they know who the LP investors were? They reached out to the former company that was running them and they said, hey, we're entitled to see the list, the cap table pretty much, and get all their information. So the governing docs basically say that the manager has to provide that information to a limited partner if they request it. So they sent all that information to that LP. That LP then reached out to all the other LPs and reached out to me. So that's how you would go about it in a standard deal. The interesting thing on these funds that I took over was I was also an LP and I was also a GP on these funds. So I was seeing both sides, but after I left that company 2 years ago, I wasn't involved on the general partner or operating side. I was just an LP and I was kind of just watching, as a standard LP. So that's how it happened.
It's interesting to me because I would, the other party here, the person that originally had the operation was not cooperative through this whole thing. So it surprises me that they gave up the names of all the LPs and showed the cap table. I would have expected they wouldn't do that. And I think that's part of the issue, not just in this deal, but in any deal when it goes south. And this deal hadn't gone south, but there was other things that caused it. And this isn't really a question you can answer, but I'm always wondering why the operator would give that information out when they know, it's going to come back against them. I guess they have to, but this operator didn't do lots of things that they were in the have to column. I'm an investor as well in that LP. And with this operator, I was in some of the multifamily deals, but really what got the operator in trouble were the office to apartment conversions that failed and went into foreclosure. And then some of the value add or ground up development deals in apartment buildings that went into foreclosure. The only thing that was operating effectively, really, a couple of multifamily deals were, to be fair, but the CRE fund was the one that was performing probably the best, paying out distributions, all the kind of stuff I like. So I don't know if you have any insight onto this, but the only asset that got voted out was the CRE funds. Do you know why the performing part got voted out with a new manager, and some of the other deals that went south or are looking like they might go south, the manager stayed the same?
A lot of the investors who were in the CRE funds were also in some of the deals where they got foreclosed on or lost 100% of their equity. So they were like, we need to basically save the ship before these sink as well. So the large investor who kind of rallied the troops had lost, I believe, 7 figures in other deals, and was looking to save their capital in these deals that they also have 7 figures in.
It's just really interesting to me. So from an LP perspective, right, I didn't know you very well. I knew that you had managed this at the other company and that you had left. That's all I knew. So I was very confused. I didn't know who to believe. I had built up trust, which has since been broken with the original operator that you used to work for. So I was nervous about what this fight would mean for my investments, right? You're taking the only good part and giving it to this guy that I don't know very well. I guess my question, if there's a question in here, is how can LPs in a situation like this know what the right steps to take are? I did not know whether to vote to change the manager or not. And, I'm pretty involved in this, all of this, right? This business. So I just froze and did nothing and thought, I'll let everybody else decide and I'll go with the group, but I'm not voting because the only real option I had was yes or no vote. And we talk a lot about how these kind of investments are illiquid, but mostly completely out of your control. And this was a way to take a little bit of control back. So I guess the real question is, how do LPs know what to do in these cases?
Great question. And I think it's really hard for investors who also were only in the CRE funds and didn't see. They weren't even aware that other properties had been foreclosed on. So they were even more at shock of like, oh, I'm still getting my monthly distributions. I'm still getting everything. Everything looks good. They had no idea that other deals were getting foreclosed on. Obviously, it's not on the news. It's not on Fox News or CNN or whatever. Like, you don't know that unless you inquire. So that was even harder. But as an LP, I'd say like being invested in the other deals was a big part for this. There were a lot of people who were in multiple deals with this operator and they had lost a lot of money in other places, myself included. So I kind of knew through the other stuff. But if you didn't know what was going on in other places, you'd be like, why would I vote? Some of the investors just reached out to me and were like, can you run these things? They didn't even know that I ran them when I was there because my face wasn't on it. And that was kind of intentional. I didn't want my face to be on it. I don't need the attention. I never wanted the attention. I didn't want my name on anything just because I don't really care for the attention. But once I explained to them, hey, I was the one who was picking the properties, picking the debt, running almost everything, they were like, okay, well, let's do it.
Zane, I'm just curious to get behind your mental well-being at the time of this happening, right? When did this happen? Was it a couple of years ago at this point?
It was less than a year ago.
Less than a year ago. Okay, so this is pretty fresh. So take us back to that point. I'm thinking today, things have worked out pretty well for you. You've got a fair bit of assets under management. You've obviously retained the trust of your investors. So I'm assuming that things have worked out to your liking. But was there a point in time when you were thinking, this isn't what I want. This is never what I wanted. You said you didn't want the attention. Did you ever want to be kind of the lead operator? And what was kind of the evolution of your mindset as you saw the situation unfolding in front of you and knew you had to take some sort of action?
I'll start with, yes, I always knew I wanted to be a lead operator. I started as an intern at that old company, and I told them day one, I said, I want to be an operator. I don't want to work for somebody my whole life. And the reason they kept me on as long as they did, and the reason I stayed as long as they did, is because they treated me really well. I got equity. I was an equity partner, and I had a lot of autonomy. I basically ran my own company within a company. So very grateful for that. Learned a lot while I was there. I will say the last year has been the hardest year of my life. It was a huge undertaking, and it could have been a much easier process, a much smoother process if the former manager had cooperated accordingly. And I don't think anybody anticipated that they would do what they did. Additionally, they bashed me for months and basically painted a picture that I was this evil, maniacal, corporate takeover guy. And it was that was really hard. I tried to never say anything bad about them, and it was it was really hard. And it wasn't really until November when the court stepped in and basically gave us a restraining order against them. And that was when really I kind of got a little bit of pressure relief from investors, because we had to pause distributions until the court stepped in. So I had 300 plus investors being like, when's my money coming? Where's my money? The former manager is saying, you're lying and they're not in control. And it was just really hard to basically say my word versus their word, and my word's right, until the court stepped in and said, yes, you are right. And here we go. So it was a really hard year. It's been a really hard year, very stressful year. No regrets for sure, but I don't know if I could go back in time if I would do this again. I will say I do feel a good obligation, and I do feel like I'm doing a good thing to help a lot of people. My parents are invested in these funds, lots of family and friends, and I feel like if we weren't in control, things would be very different, and these funds would not be as healthy as they are right now.
I want to get to the real stuff, which is what we want to talk about, but the last thing I will say on this is, it was really confusing as an LP, because the one guy that I knew and trusted, knew, liked, and trusted, right, was telling me that you were trying to steal stuff and that you were behaving inappropriately. And when the vote came through, he said that, the vote wasn't right and people were lying, and none of that was correct. And the whole time you're right. You did not go down in the gutter and call anybody names. You didn't call anybody a liar, even though you knew you were on the right side. You were just waiting for it to come out and be presented in the correct way. So I really want to commend you how you handled this. I didn't like the whole process. That was not your fault at all. It was very confusing and very upsetting, because we have all this money and we don't know what's happening to our money, and we have two guys fighting about it, and one and you don't know the other. But, I just want to say thank you for being a good steward of our capital and fighting for what's right and not getting down in the gutter. So with that, I'm going to give Paul the first question on the real reason we're here, which is to talk about triple net leases. Now, that was a good education on manager change, and you handled it great. So, Paul, why don't you get us kicked off with the real topic?
Yeah, before I do, being sort of a listener to this conversation and not an active participant, it sounds like you really handle things the right way, Zane. And this business is not for the faint of heart. And obviously, you've taken some lumps and probably grown thicker skin over the last year. So hopefully things are on the up and up from here on out. But let's talk about the business that you are now, the steward of. Before we get into sort of your business model and what characteristics of properties are attractive or what the thesis is, just talk to our listeners a little bit about what a triple net lease is. Let's back it all the way up and help them understand what triple net leases are.
Yeah, so a triple net lease basically puts most of the operational expenses on the tenant. It should put all of them. So an absolute triple net lease means the tenant's responsible for taxes, insurance, and common area maintenance, or CAM, meaning they take care of everything. And as a landlord, you own the hard asset, the physical structure, and then the tenant is responsible for all of the management and operations of the property.
So what types of tenants are we talking about when you look at these businesses?
I mean, it could be anything from a triple net. So You could look at a retail center, a strip mall, an industrial warehouse, an office building. So those are obviously all the triple net stuff. And what we personally look for at Freedom Commercial Real Estate is we only buy tenants that are investment grade tenants, and we buy properties where the properties are single tenant net lease properties. So think Starbucks, Dollar General, AutoZone, Verizon Telecom, O'Reilly Auto Parts, Kroger, Walmart, all these publicly traded companies that are paying your rent and taking care of a lot of the day-to-day operations. And you, as the operator, own the building and you have them paying your monthly rent.
Can you talk about like the benefits of this type of arrangement and maybe the downsides too? Because I would think that you own the property, but you don't really have to do anything because they're doing everything, which is great. But also, if they're doing everything, that means they're in charge of the maintenance, and some things might get overlooked as they're pinching pennies or whatever. So can you just kind of give us a little bit of the upside, downside of this type of arrangement?
Yeah, so I'll start with the upside. I think when you have these high credit, multi-billion dollar companies that are paying your rent, you don't have to worry about collections. You don't chase rent. It comes to you, and it typically comes early or on time. It's never late. Like I said, I've been doing this for 7 or 8 years now, and I've never missed a rent paycheck from any tenant, which has been very good. That differs a little bit if the tenant goes bankrupt, and we can get into that. But the pros are the management goes on the tenant, and you as a landlord kind of have a kind of hands-off approach. And every lease is very different, though. So a lot of these properties are triple net, absolute triple net, where you do nothing as a landlord, and some of them are double net. So this might be a little bit of a con, but we are responsible for some of the repairs and maintenance on some of the properties. So every tenant is different, from Family Dollar to Dollar General, from CVS to Walgreens, from AutoZone to O'Reilly's. Like, they all have different nuances to their leases, and there's reasons to kind of go with one over the other. But in the majority, like, they take care of mostly everything.
So as you're naming some of those familiar names, how critical is it to underwrite the underlying business versus the physical real estate and where it's located? Is it sort of a trade-off, one or the other? Is it a combination? How do you look at that when you're evaluating deals?
I think you kind of got to balance both, and it's really dependent on what you're looking for. But there's really two things that go into the valuation of these assets that we buy, and it's really the lease, the length of the lease, and the creditworthiness of the tenant, and then obviously the location. But really the how long the lease is, the longer term the lease is, the more valuable the asset is. The higher credit the tenant creditworthiness is, the more valuable the tenant is, and then the location's good. So what we look for is basically a combination of all the three, and with the cash flow metric that we need to hit in terms of cap rate. So, we might do a little bit worse location for a high credit tenant with a longer term lease, knowing that even if we have an AutoZone in a 1,000-person town, but it has a 12-year lease on it, like, AutoZone's going to be on the hook for 12 years no matter what, and they're not going out of business. So we know we're going to get X for X amount of years. So we can kind of plan accordingly. Kind of if we want to be a little bit riskier in terms of a shorter term lease, we might look more at the location and weigh heavier on the actual location and for the need to repurpose if the tenant does renew. So every deal is different. The way that we run our offerings is as a fund structure, meaning an investor comes into the offering and they have ownership across 10 to 20 different assets. So they are diversified across different geographic locations, different lease terms, different tenants, industries. So they're very diversified. And with that diversification, we can diversify each property differently in those kind of buckets that I just mentioned.
And you also mentioned, if a company goes out of business, right? And that's happened. That will happen again. So what happens then? What happens to the investment? What do investors do? What do you do?
So that's where the fund structure is very beneficial. We had 2 Rite Aids in our funds, and they were both in very good locations, hard corners, high trafficked areas. And one of them was a very desired location that basically we've had tenants come and be like, hey, we want to buy the land from you, and we'll use this land for our business, and we want to drop in a new property, and we'll put a ground lease, or we'll buy the building. So what happens to the lease when a tenant goes bankrupt? That was your initial question. They rejected it in this situation, basically saying we're not going to pay rent anymore moving forward. And once that happened, actually before that happened, but once that happened, we started shopping and being like, okay, what are we going to do to repurpose this piece of real estate? Because that's the good thing about these is we own the hard asset, we own the real estate, we own the land and the building. So the first initial kind of easiest transition would be, let's go find another drugstore that can come in. Let's go find a dollar store that can come in. Let's go find an auto parts store and just come into this 12,000 square foot building. You can't find that. Then you start going to different tenants that could potentially repurpose the land.
Maybe this is getting in the weeds, but Rite Aid goes out of business. Do you own all of the shelves and all the merchandise on there because they stop paying rent? You just go in and say, "See you later, Rite Aid. I'm, taking your frozen pizzas and razors or whatever they have in the store."
That would be the first thing you went for, wouldn't it?
Yeah.
100%.
All the ice cream shelves I actually have a ton of ice cream in my freezer. I went there and stocked up. But, no, they take everything out of them. I think one of them they emptied completely. And then the other one, they left the shelves. The one that they emptied completely, that's the one where you've had a ton of traction and a ton of interest from other tenants. And then the other one, we have like smaller people, like local liquor stores or, Halloween, Spirit of Halloween has shown interest in it. So we're looking for the right tenant, not just somebody to come in and pay us a little bit of rent. Being a good fiduciary of investors' money and not just taking the first thing that comes is a big responsibility.
Zane, I've looked at a couple of these types of deals that have just come up for brokers that I'm connected to and tried to pencil them out and haven't really made sense of them, frankly. And we've already beaten you up quite enough, but I'm going to ask you just a tough question. Like, how do you make these deals work on paper with interest rates climbing as high as they have? It seems like they've often been given the name of sort of a coupon clipper, if you will. They're lower on the risk spectrum, so to speak. So the returns are going to be a little bit lower. But when you add in the cost of capital today, it seems like it's very difficult to pencil them out. How do you make it work?
First of all, you can ask as many questions as you want. I can talk about this all day. I love this stuff. It's like, I think about it all day. I was literally like working out this morning, just like thinking about it. So ask as much as you want. But how do I make them pencil out? I guess I'll answer your other question first of like, these are low risk plays. Like you're buying the high credit tenant with the long-term lease. And when you have it in a fund structure, you're lowering your risk as much as you can. So the returns are going to be lower. We're aiming for singles and doubles. We're aiming to get on base, make contact over and over again. We're not aiming for the triples and the home runs. If investors want that, go do development, go do value add multifamily, something else. That's not what we're trying to do. So we are getting lower returns. But the thing is, we're consistent, we're stable, we're predictable, and we're backed by multi-billion-dollar companies. So the diversification is really good. So in terms of penciling out, there's a lot of levers you can pull, but there's less levers on these than you can in multifamily. But the big levers you can pull are the loan you get on the deals and the cap rate you buy. So lenders love these deals. They love a lease backed by a $100 billion company like Starbucks, and they're going to give you the best terms. And what I do is I take lenders and I bid them against each other, and I make them basically duke it out and give me the best terms that they can. So I'm getting below market rates on pretty much everything.
Is it recourse debt?
Yeah. So I sign on all the loans personally, and it's the risk you take. So recourse on those. And then in terms of cap rate, like I am sifting through deals all day, every day. I'm talking to brokers all the time. We're actually closing on a deal today that I watched for almost a year before I made an offer on it. It went under contract with a different buyer. We made an offer on it initially about a year ago. Didn't get it. Went under contract with a different buyer and fell out of contract. I followed up like 6 months after and was like, hey, did it close? They said no. So we actually got it 16% off of their ask price and got it at an 8.2 cap. And we got 6.4% debt on it with 12 months of IO. It was a good deal. And we already are in contact with the tenant. It's an O'Reilly Auto Parts. We've already contacted them and they're open to an early lease extension. So it takes a lot of work. I put a lot of time and effort into buying the right properties, building a good fund, and building relationships with these tenants. So if you get a Dollar General from a broker, that's a new build 15-year lease in small town North Carolina, but it's a 7 cap, like you can make that work. Just pay cash for it or lower your leverage and you're going to cash flow to some capacity. It's just, what do you want? I'm going to go one more thing and talk about equity multiples on this, because you can get equity multiples if you do it right. So for this deal, example, we're buying it for $700K at an 8.2 cap. I think if we can get a 5 to 10 year extension with O'Reilly, it's going to be worth about a 6.5 cap, and the value will be worth about $1 million, and we're putting down $250K, $300K on it. So we're going to double our equity probably in the first 3 months of ownership. So these boring, stable investments doubling your money in that quickly. It doesn't happen all the time. And I'm not painting that picture, but if you can mix that in with some of the lower risk, kind of lower yield plays and kind of have some bigger pops in there, that's where it comes.
Interesting. So what's the exit strategy overall of the fund? How many assets are in it today? And what do you see like 5 years from now?
So the fund that we're currently building, the exit strategy is to buy as many properties as we can by the end of this year. We just closed on our 8th today. We have our 9th under contract. We'll probably have 15 when this one's said and done. And the goal is to extend the leases on as many as we can, make the values as high as possible, roll it up, and then sell it to a REIT, a pension fund, a private equity group, basically roll up and sell 15 investment grade hard assets that are cash flowing to somebody. And the hope is that in the next 12 to 24 months, interest rates come down and cap rates compress and our valuations go up. So I think the properties we're buying today are going to have some good appreciation. I'm going to say I hope they have, with an asterisk, because nobody knows what interest rates are going to do. And even if there's no cap rate compression, we put fixed rate debt on everything. So we know the cash flow that we're going to have. We know the rent that we're going to have. And we can weather pretty much any storm from a cash flow standpoint until cap rates compress and we can sell at a higher valuation.
Is there a value add component here? Is it just, are the rent increases built into the contract? Is there anything you can do after you buy the asset to kind of make it more valuable?
Manipulating the lease is the biggest thing. So like this O'Reilly example of, we reached out to O'Reilly prior to acquisition and said, hey, we're looking at this property. Are you guys interested in lease renewal? And they said, yeah, we are. Let us know when you close on it. So I'll reach out to them tomorrow since we closed today. And I'll be like, hey, we're ready. So having a good relationship with those kind of regional real estate managers is important. We already locked up another lease extension with this manager. So that's the big one, is lease extensions, like the term and the rent, the NOI are the two big things. Outside of that, I'd say if you are on a property with a big piece of acreage, you might be able to parcel out something. We've never done that, but that's another option. Another option I've seen is adding billboards. I've seen people add billboards on highways. That's a small thing. You maybe get $500 a month or something, but $6,000 a year on a 6 cap is $360K. Is it 360 or is it 36K? Somebody fact check me and send me a message on that.
Yeah, I can't do math on that run. That's Paul. Paul should have that in his little calculator in his brain.
I think it's just 36K in value.
More than nothing.
Yeah, exactly. It's still value. And those are pretty much big, but the biggest thing is really the lease. And
you mentioned the exit, perhaps, rolling it up into a REIT or something like that. Is that fund by fund, or, the way this was kind of set out to us when I first invested, it was 5 years ago with the original operator, was, going to do 5 funds, roll them all up into one big thing, sell it to a REIT in 2025. Well, some things got in the way, the market and all that, so that hasn't happened. But what's the plan, not only for the new fund you're doing, but for the old funds that you took over?
The first 4 funds have a little bit different strategy. We're just going to try to sell the properties off as the time comes and sell them for as much as we can. Some properties will make money, some properties will break even, and some will probably lose some money on. I think a lot of investors are kind of ready to be separated from that former group and just get as much money as they can back. That's what I'm trying to do, is as a lease comes up for renewal, let's sell it. If there's valuation that's in a deal today, let's sell it. If we can sell it for a little bit more than what we paid for it, let's get out. Some deals we're going to lose money on, and it's kind of just like finding the balance to get investors back as much as their money. And it's a little bit difficult situation on some of those just because a lot of people want out. So it's like, let's get them out and let's get them as much money back as they can.
Is there a typical remaining lease term where you start to see cap rate expansion just based on how much is left on the lease?
These deals basically decrease in value from the day the lease extension occurs. So if you think of, getting a 5-year lease extension from 5 years down to 1 day, it's slowly decreasing in value until the new lease extension occurs, and then it spikes in value, and then it slowly decreases in value. And that's assuming a consistent cap rate environment. So let's say cap rates are compressing, that decrease might actually be a little bit slower decline. Or if the cap rates are compressing faster than the value is decreasing, then you still might increase in value. So really the value is in the length of the lease and the creditworthiness of the tenant. And as the lease term lessens, the value lessens proportionally.
It's got to be a delicate balance to consider, what you have in the portfolio from the old partnership versus what you're bringing in today. And when does it make sense to exit and when does it make sense to hold?
Yeah. So just for clarity, they're all separate. These are 5 separate funds, 5 separate investors, investor pools. And, the strategies on the first 4, like Jim said, we wanted to go public through an IPO by building as much as we can and then IPOing and then executing it over and over again. That has since changed for obvious reasons. And I never wanted to really IPO. I thought it was a lot of restrictions and stuff that I didn't want, but I didn't want the attention and other people did. So it was just like, our strategy is a little different and let's just do it on a smaller scale and rinse and repeat.
Well, this has been fascinating. This CRE triple net lease stuff, I love it. It's one of my favorite asset classes. Zane, thank you for being on the show. And just one final time, I do have to say that this has been difficult for you. It's been difficult for investors, the way the transition happened. But you handled it with grace the entire time. And that's given me confidence. And I just thank you for that because it was, as much as it was difficult for me, I know it was much more difficult for you. So thank you. And also thank you for kind of educating us on what CRE is and the triple net lease and all that. So thank you very much.
I appreciate that. That means a lot because in the back of my mind, I was like, I hope people see the truth. But I'm glad that you did. And a lot of other investors have reached out and said the same thing. So my integrity means a lot more to me than my business. And I hope that my character showed through the way that I handled the situation. But thank you for having me on this. I really enjoyed talking about it. Like I said, I could have talked for hours, but I know we got to cut it off. But yeah, thank you. I appreciate it.
Thanks again for being on the show, Zane. If people want to learn more about you or your company, what's the best way to get a hold of you?
My direct email is zane@freedomcre.net. They can visit our website, freedomcre.net. Or you can follow me on LinkedIn, Zane Schartz, and I post a lot about kind of deals we do, what we look for, and how we're growing. But we're currently raising for a couple offerings and always looking for investors, so we'd love to help.
Awesome. We'll put that in the show notes, and thank you again, Zane.
Thanks, Zane.
That wraps up our episode covering everything from LP rights and real-world fund transitions to the fundamentals of triple net lease investing. Big thanks to Zane Schartz for bringing clarity and insight into a space that many passive investors don't get to see up close.
If you enjoyed this episode, be sure to like, subscribe, and leave a comment. For more tools and education, visit PassivePockets.com and check out our 7-day free trial. Thanks for tuning in, and as always, happy investing.